It's June 2026, and the financial landscape is shifting at breakneck speed. Right now, we are seeing unprecedented moves to push highly complex, historically restricted assets directly onto the smartphones of everyday people. So, is this true democratization? Or just a really sophisticated way for institutions to offload their risk onto you? In today's Explainer, we're taking a completely de-hyped, data-driven look behind the headlines to find out. We're cutting through the noise in 5 key areas today: the retail investment boom, the whole prediction markets versus casinos debate, the hidden risks of private credit, the mega IPO trap, and finally, actionable takeaways for you. Section 1. The retail investment boom. Selling risk to Main Street. You know, historically, the most speculative financial assets were gated off. They were reserved entirely for ultra-high net worth individuals and massive institutional funds. But right now, that entire model is flipping upside down. Just take a look at the massive record-breaking news dominating the market right now. Elon Musk's SpaceX is intentionally bypassing traditional institutional guardrails, selling an unprecedented 30% of its upcoming public offering directly to retail investors. To put that into perspective, mega IPOs usually reserve maybe 5 to 10% for everyday investors. It's the defining event of the AI IPO race, and they are aggressively marketing this to you to fund incredibly capital-intensive projects like space data centers and Mars colonization.
And this brings us to the core problem. Are we actually seeing true democratization here, or just the rapid retailization of high-risk assets? I mean, the pitch sounds fantastic, right? Get access to the same growth vehicles as the billionaires. But when you objectively look at what's being pushed, whether it's space exploration, unregulated betting, or private corporate debt, the reality is that everyday investors are often unknowingly absorbing the massive risks that institutional money is actively trying to offload.
All right, Section 2, prediction markets or casinos, betting on the future. We are currently watching the sudden explosion of unregulated trading platforms transform into a multi-billion-dollar industry almost overnight.
Platforms like Kalshi and Polymarket are pitching themselves as truth engines. They offer a way for you to profit off your unique insights, completely dodging traditional gambling regulations. Because of a legal technicality, these binary event contracts are overseen by the CFTC as commodities, rather than falling under strict state gambling laws. They advertise the whole thing as a highly sophisticated way to hedge risks or monetize your news consumption.
You've probably seen the ads everywhere. Young influencers claiming they literally paid their rent by betting on weather patterns or pop culture breakups. The gamification is intense, and the referral codes are absolutely everywhere. But we have to ask, when you are competing against algorithmic market makers and insiders who have immediate access to information, do you really have a trading edge, or are you just rolling the dice?
Well, here is the harsh reality check. Independent data shows a staggering 84% of Polymarket users have actually realized losses. Let that sink in for a second. Despite the influencer hype about copy trading your way to a new Lamborghini, independent blockchain analysis of over 2.5 million participants revealed that the vast majority of retail users are just bleeding money. Once you factor in platform fees, it's a negative-sum game for the average person. And despite all that high-minded executive talk about economic forecasting, the hard data tells a completely different story. Nearly 80% of Kalshi's $13 billion in monthly volume is strictly sports betting. The core engine driving these platforms isn't sophisticated hedging, it's traditional sports gambling, which is an activity known to carry immense risks, especially for younger retail users.
Let's move on to Section 3. Private credit's hidden risks, high yield, high danger. Because this retailization trend is aggressively spilling over into the $2 trillion private credit market, an area of the financial system that has grown tenfold since 2008 by lending money where highly regulated traditional banks won't.
Driven by exorbitant fees, these non-bank lenders are now pushing highly complex debt products to regular folks via everyday brokerage apps. In the past, if you wanted the high yields of private credit, you needed to be a massive pension fund or a family office equipped to handle the fact that these loans are incredibly illiquid and opaque. Now, brokerages are democratizing this access, allowing everyday retirement accounts to buy right in.
But guys, here is a very sobering number. The default rate among corporate private credit borrowers recently hit 9.2%. That is rising above pandemic highs. These funds lend heavily to software companies and mid-sized businesses at floating interest rates, and as rates have stayed high and the economic environment has tightened up, a lot of these companies are seriously struggling to make their payments.
To quote Jamie Dimon,
When you see one cockroach, there's probably more. And right now, institutional heavyweights are seeing a lot of bugs. When supposedly top-tier debt is downgraded to deep junk overnight because companies double-pledge their collateral, it reveals massive blind spots in this unregulated shadow banking sector. The sheer lack of transparent price discovery here is a massive red flag.
And this creates a really dangerous liquidity trap. Think about it. If you buy a normal stock and get spooked, you sell it in seconds. With private credit, your money is locked inside private business loans. When panic sets in and everyday investors rush for the exits, fund managers legally pull down the metal gates, they halt redemptions, and you simply cannot get your money out.
Okay, Section 4, the mega IPO trap, buying the hype. Let's circle back to that explosive SpaceX IPO we mentioned at the start, and look at the actual financial math driving this illusion of a ground floor opportunity.
When we look at the objective math, SpaceX is hitting the market at a staggering 90 times price-to-sales ratio. That wildly outpaces actually profitable tech giants. I mean, Google and Meta sit around a 10x ratio, and they have massively profitable, established operations. SpaceX's AI wing is growing slower than the rest of its business, and the company is operating at a loss. That valuation is priced purely on science fiction perfection, which leaves absolutely zero margin for error for the retail investor buying in today.
Because while the prospectus is hyping up Mars colonization, the insiders are preparing for payday. They are set to unload nearly $1 billion in shares shortly after the IPO. When a company's public float is incredibly small, under 5% in this case, and insiders hold massive quantities of stock that will soon be legally allowed to be sold on the open market, it creates an enormous amount of downward pressure on the stock price.
So we have to neutrally address a really important counter-argument here. Is this democratized access actually just a sophisticated way to use everyday people as exit liquidity? It's a harsh term, but it is absolutely vital to understand. Venture capitalists and early insiders need a massive pool of buyers to cash out their high-priced shares. By lowering capital requirements and marketing heavily to retail, they generate the hype and the buyers required to secure their own massive payouts.
Finally, Section 5, actionable takeaways for you navigating the noise. Understanding how these products are built to favor the house or early insiders gives you an incredible advantage in protecting your own portfolio.
Here is your de-hyped framework. Avoid illiquid traps, ignore the sensational hype, and remember that real wealth building is based on fundamentals, not gambles. If an asset doesn't trade on a public, transparent exchange, you need to tread carefully. If an influencer in a bathrobe is promising you can 10x your tax refund in 6 months using binary options, run the other way. True investing is about owning productive assets that generate cash flow over time, not placing bets on the day's news headlines.
Ultimately, when someone offers you unprecedented access to highly hyped financial products, you have to ask yourself this one vital question before you ever hit buy. Are you truly getting a seat at the table, or are you just paying the bill for the people who are already finished eating? Stay disciplined, look past the hype, and invest wisely.